Welcome to this video on real estate versus gold versus stocks, best inflation hedges. We will explore how different asset classes can protect your wealth against inflation. First, what is inflation? Simply put, inflation is when prices rise and the purchasing power of your money declines. Inflation matters because it erodes the value of your savings. This is why having assets that hold or increase their value over time is critical. We will compare three major investment options often considered as inflation hedges: real estate, gold, and stocks. Real estate involves investing in property, land, or buildings. It is a tangible asset and a traditional avenue for building wealth. The pros of real estate include its stability, tangibility, and the potential for steady rental income. However, real estate has drawbacks, such as the high upfront cost and relatively low liquidity compared to other assets. Gold is a traditional safe asset. It has been used as a store of value for centuries and often performs well during economic uncertainty. The advantages of gold are its safety, high liquidity, and its historic role as an inflation hedge. On the downside, gold typically provides no income, and its price can be subject to market fluctuations. Stocks represent ownership in companies. Investing in stocks means owning a piece of a business's success and future growth. Stocks offer high returns and significant growth potential, especially for companies that can raise prices during inflationary periods. The main cons of stocks are the inherent risk and high market volatility. When comparing these options, consider the balance between risk, potential return, and liquidity. Ultimately, the best choice depends on your personal financial goals and risk tolerance. Diversification is key for mitigating inflation risk. To summarize, diversify your investments across real estate, gold, and stocks to best protect your wealth against inflation.